Hey, welcome to the exchange. Hey, Allbirds just released their Q1 2022 basically financial earnings. Overall, I mean, it was pretty ugly, but it's not terrible. Let's see, first quarter net revenue increased 26% to 62.8 billion, so that's pretty good. Increased 49% compared to first quarter 2020. So they're saying, hey, 2-year growth rate there, it's 49%, which again, pretty strong growth rate. First quarter 2022 gross profit increased 26% to 32.6 million compared to 2021. It's roughly about a 50 or 51% gross margin there, which is higher than norms. I mean, most shoe companies are talking like 47, 48%, especially right now. So they're a little bit above the norms, a little bit higher margin, not extreme margins. For extreme margins for like high-end shoes, you're seeing about 58, 59% potentially there. But again, it's not too bad overall. So overall net loss on a GAAP basis of 21.9 million or 15 cents per basic diluted share. First quarter 2022 adjusted EBITDA loss of 12.2 million. So again, pretty heavy losses, not terrible, I would say, in the long term potentially if they can basically change their business model around. We'll look at the data a little bit later, but again, it's not too bad for what I was expecting for Allbirds. And I see the last bullet right here. So physical retail channel sales grew 129% in the first quarter of 2022 compared to Q1 of 2021. Again, it's a small base effect there. So basically, if a small number, it's going to grow pretty fast just because you're basically growing it. It's much cheaper, much easier to grow that number itself. So even though it looks really good on the actual report itself, I mean, take it with a grain of salt because it's not like a massive blowout. It's the exact same model I used in my previous videos. I tweaked it a little bit for some of the changes here. So anything you see in bold, basically a number that changed, it really surprised me. So revenue here, I see 344 million. I mean, it used to be 360, 370 million. Revenue's come down quite a bit, at least the guidance revenues for 2022 overall. Gross profit, it used to be much higher. I think it was like 52%. Now it's at 51% roughly, or in that ballpark. I'm looking at SG&A expense. I mean, it's basically in line. So they haven't cut SG&A costs at all, which is absolutely terrifying to me because it's a massive cash burn compared to the revenue base. Marketing expenses has come down quite a bit. You see 2021, 17 or 21%. Now it's at roughly 16%. So they're actually marketing much less than they were in 2022, which sounds bad because obviously you want revenue to grow. But I mean, the marketing expense is so high where I'm actually happy about that. As an investor, I'd be very happy with the actual marketing revenue coming down or marketing expense coming down for Allbirds. Overall operating income, I'm saying this year negative 35 million. I mean, net income saying negative 35.8 million, which again, it sounds bad, but it's not massive amounts of money, and they're relatively debt light. I believe they only have roughly, I think, 14 or 15 million dollars or $15 million of debt. Actually, let me check real fast. Scroll down. Yeah, non-current liabilities, so 12 million right there. So I mean, the debt load itself is not much at all right now. So again, I'm not too worried about the debt load itself. So if they actually have to, they need to raise debt. I mean, they absolutely could if they wanted to. I pulled out here. So there's really two comments I think is very interesting, or two things I saw. So SG&A expense in first quarter 2022 was 38.8 million, or 61.7% of revenue. I mean, that is absurdly high. That is crazy high. Like, if you're an investor in Allbirds, you want this number to come down as much as possible. I mean, this might be, honestly, and it sounds bad, this might be the form of layoffs. I mean, this number is too high for the revenue base. You have too many staff and too many expenses for your actual versus your revenue base, or it cannot keep growing. I mean, this number is almost like a startup. I mean, this is crazy high, and it's got to come down. I think it will. The question is how and how fast too. Because I mean, if this lasts in 2023, I mean, they're going to be absolutely done. They're going to be killed by the actual operating expenses. Quote from the CFO. So he's basically saying, our expectation that these external headwinds are transitory, coupled with the underlying strength of our model and strong execution by our teams, makes us confident in our ability to achieve our medium-term financial targets, including 20% to 30% net revenue growth, gross margin of 60% or 60% plus, and mid to high teens adjusted EBITDA margin. What we're saying right here is this number right here, it's got to be in the 20 to 30% range for the near future. I mean, if it drops below 20, I mean, it's going to be bad. I mean, stock could be sub $2, potentially even less. I mean, it could be a very bad number right there. Overall, I mean, it's very possible. Margin will grow, I think. This might be a short-term, hey, cost of goods sold or high inflationary environment, etc. I mean, 60% plus, and that's a strong goal. I mean, I'd be shocked if they're in the 57, 58% range. I mean, if nothing else, and this might say, like looking at this and say, hey, they have to raise prices because these margin numbers are way too low for what he wants right now. Look at that price to sales forward ratio. What I'm saying right now is they're trading roughly about $4. I'm assuming $4 when market opens tomorrow. I'm assuming right now, I mean, looking at peers, they're trading about 0.9 price to sales ratio, which I think they might be above their peers. I mean, if I had to guess, I mean, I'd say fair value right now is probably at 1.5 mark, about $3.37 right there. Looking at FY26 EBITDA multiple, I'm saying right here, I mean, really looking at the 367 and 459 is kind of the base case in there. I think 3X is too low for their business style, especially if it's a premium kind of, premium semi-luxury product right there. So if I had to guess right now, I mean, they're a little overpriced, but not by much. It's getting that range where it's almost like fair value, in my opinion, at least. Hey, but that's Allbirds. I mean, I think it's getting near that fair market value. If I was an investor, I might start dabbling right now. But again, I really think that base floor is probably $2 potentially, maybe $3. As the kind of the ground floor. But again, if it goes below that point, I mean, they have the cash on hand, they have a low debt. I mean, at that point, just take the company private. I mean, it's getting so cheap right now where it's like, hey, just go ahead and tap it out, keep the cash and keep all the equity for yourself, etc. Hey, but be sure to sub, like, comment down below, and that's the exchange.